So let's discuss the CFA Level 1 syllabus. First of all, why do you need to understand the syllabus? One, to decide in terms of, you'll be spending so much time studying, you are going to be working, learning something. So you need to know what you're learning. You need to know all the subjects so that you have a broad overview of everything that you're going to study, the interrelationship between the chapters, so that, in your mind, okay, these are the pieces I'm studying right now, so that you can put it all together. And you're going to be studying, most of the subjects are going to be new to you. So that is the reason why you need to understand and do this syllabus lecture very, very well, because you need to know exactly what you're studying, how everything is related. Second is, when we're looking at the structure, what happens is the institute divides the structure, divides the syllabus in a very, very methodical manner. Please understand, we're looking at global examinations over here. When we're looking at global exams, students would be studying across the world. We cannot have confusion like out of syllabus question, what is in the syllabus, what is out of the syllabus. So therefore, the subject and the entire curriculum is defined in a very organized manner. So how does the structure work? So basically, we have, let's say, 10 subjects in each of the levels. In level 2, level 3, the subjects might change. I'll discuss that also. We have subjects like quants is there, economics is there, etc. So we have, let's say, 10 subjects. For every subject, we have something called the learning modules. So suppose we have a chapter on time value of money, we have something on statistics, we have something on probability. So we have these chapters. Every chapter, the subheadings have been defined, which is known as learning outcome statements. So the chapter's subheadings have also been defined. Now I call it chapter because we've been calling them since school. You can call them reading or chapter or learning module, whatever it is. Ultimately, it is chapter for me. So whatever is comfortable to you, it's okay. So these are your subjects. Then you have your chapters or reading numbers or learning modules. So the nomenclature keeps on changing. And this is your learning outcome statement. So at the very minute level, the syllabus is defined so that there is absolutely no confusion in terms of what the syllabus is, what is going to be testable in the exam. 99.99% from my understanding is that the institute is going to ask questions only what is there in the syllabus. You would barely find maybe 1 out of 200 questions or 300 questions that is tested, which is something going above your head or out of syllabus. So that is not a problem or anything material to think about. Also, the LOS is defined to such a level where an LOS, if it tells you explain or describe, that means numerical is not going to come on that. But if it tells you, you should be able to calculate XYZ. So in that case, the numericals, the numbers, the calculation is going to be there. So the LOSs are going to be very well defined so that there is absolutely no confusion. And anyways, once we study the chapters and all, you know which sums to do, which chapters and what concepts are there and everything. So the entire syllabus has to be covered thoroughly. There is no selective studying. With respect to the non-finance or non-commerce students during graduation level, so what happens is, I've seen commerce students somehow having a little challenge with quants. That is the maths part of it. So they will not like quants. They will be better at financial reporting analysis. That's the accounts related chapter, if I could say so. I'll explain all the chapters in detail. So what we see is the commerce student might have an edge in FRA, but may not like quants that way. An engineering student or a science student might be better off doing at quants and may not be that good at FRA. So you'll obviously have to put in more effort at FRA. There would be an economics honors student who might be good at quants and economics, but may not be at FRA. So it will depend on what is your background in terms of bachelor's, but there is absolutely no problem because everything is taken from scratch. In fact, you're not supposed to be phobic with quants. I'll discuss the quants bit also. So those who have a problem with maths, do not worry. We'll discuss that part. There'll be absolutely no issues with maths. Just a little extra hard work with the maths is needed. We don't have algebra and trigonometry and all that. So let me come to the subject and then I'll give you the details about it. But every student from different stream will have different edges in different subjects. So that will not be a problem, but mostly it's going to be finance subjects, derivatives, fixed income, equity, alternate investments, ethics, etc. So most of the subjects I think is going to be new to you. And to understand, when you're moving forward with your career and when you're looking into finance, the syllabus gives you an outline as to what is finance all about also. So you need to understand that very, very well. Next is with respect to changes. So the syllabus stays the same throughout the year. So in one calendar year, so let's say January to December, all the exams are going to have exactly the same syllabus. The syllabus changes from one year to the other, and that change is also not so much. There could be a couple of chapters deleted, a couple of chapters might have some changes, a couple of chapters might be new. So those changes are covered regularly in the live class. It's shared with all of you. So that is not a problem. As and when the new syllabus every year turns up, we do the changes lecture. But otherwise, the syllabus is more or less 90%, 95% would be constant, and the basics are going to be the same. There could be some reshuffling. One LOS of a chapter, one part of the chapter might change, or might be deleted, etc. So broadly, we need to understand what is finance all about and what is the syllabus all about, right? And the order of studying. So also to understand the syllabus is very important because there are some interconnections between the subjects. So there has to be a flow of your studying. So to know the syllabus and making sure that, you study in the particular order. In fact, the order of study is provided to you. I try to, alternate between theory and practical subject. I try to alternate between easy and difficult subject. I try to put those subjects at the end which have more retention issues so that, it is closer to the exam, etc. So you follow the order and there will be some interrelationships between the chapters which you need to understand. So let's get into the syllabus. So subjects, 10 subjects which have chapters, and each chapter is divided into smaller subheadings of the chapter, half page, 1 page, etc. Right? So let's move forward. So the first subject we're going to be talking about is quants. So again, those people who are phobic with maths or something, don't worry, you have to work a little extra hard. So let me explain what the curriculum is first. So when I'm looking at quants, I am not using the exact name of the chapters over here. I'm trying to explain the syllabus over here. So we'll be doing the examples and all. I'm not describing every single chapter at length. We are discussing broadly what the subject is. So the terms I've used is broad terms like statistics. The chapter name might be a little different. Like time value of money, you'll have rates and returns, time value of money, etc. But I'm discussing the outline over here. So as to how the syllabus and the subject is looking like. So when I'm looking at time value of money, you might have done simple interest and compound interest in class 8. So anytime you take any decision, even if you want to take a home loan, you have to make a decision. So how do you do that? You have to understand numbers. You have to understand the money related calculation, the simple interest and the compound interest. And trust me, I don't know if I'm supposed to say this because there could be a lot of bankers. So when the banks sell wealth products, they will try to sell you the product in which the bank will give you less return, right? Because then only the bank will make more money. So you have to understand very well, because I end up not buying most of the bank products which they try to sell me. So you have to understand that, okay, whether a 3-year FD is better or a 2-year FD is better. Whether the FD is giving you quarterly interest, every 3 months you will get interest, is that better? Or every 1 year you will get interest, is that better? So you have to understand the nuances of money. Even if I'm coming up, let's say I'm going to start a factory of my own. So in the coming 3 years, let's say I'm going to be investing money, and 4th year onwards, I will start making sales. My factory will start running. So how do I do the calculation? I need to understand the time value of money. I need to understand, because 100 rupee today is not the same as 100 rupees after 5 years. You would always choose 100 rupee today than 100 rupees after 5 years, because if I get 100 today, I can deposit that in the bank and I can get more money after 5 years. So how do we do that calculation? So all the money related calculation is what we study in the time value of money part, and what kind of interest rate to use. For example, I'm going to demand, let's say 7% from a bank. But if I'm investing in a stock, let's say I'm investing in a Tata Motors, I'm going to demand a 12% return, because Tata Motors' stock is risky. When I'm putting the money in the bank is guaranteeing the amount of money that they will pay me. Right? The interest rate is fixed, but a Tata Motors is not going to do that. There is risk when you're investing in a stock like that. So therefore, the interest rate that you use for different kinds of security, one is a FD kinds, bank, fixed deposit, fixed income. One is an equity like shares, markets, there's market risk. So that way. Next, when we are taking any kind of decision for the future, you have to understand, suppose I believe that India's growth rate, there is a 50% probability India's growth rate will be 7%, there is a 30% probability it will be 6%, and there is a 20% probability the growth rate will be 4%. So on an average, I'm expecting the growth rate will be somewhere around 5, 5.5, 6-ish. So how do you do that calculation? That is probability. So we need to understand probability in order to make forecasts. But how do you assess probability? You study, okay, last 10 years, how has the growth rate been? Last 10 years, what is the data? So always you have to study data, the past data, right? Data is the new oil. So statistics becomes very important. So TVM and probability is still small, but 70% of the content is going to be statistics. And statistics in 11, 12, those who have studied maths, mean, median, mode, standard deviation, etc. You have kind of mucked up the formulas, mostly from what I've seen. But you need to understand the logic. What is the difference between a mean and a median? Let me give you an example over here. So say, suppose there are 10 students in a college, since everybody is very concerned about the placements and all, and rightly so. So there are 10 students. Let's say every student is going to get 10 lakh rupees as salary. So there are 10 students, all 10 lakh rupees salary. So the average is also equal to 10 lakh. Now suppose I make a change. In these 10 students, everybody's got 10 lakh salary except one student. So 9 students have 10 lakh salary, one student get 100 lakh salary. Now what will happen? Your average is going to shoot up. This 9 times 10 is 90. So 190 divided by 10, your average is 19 lakh. Now, when I'm looking at this college, let's say it is saying that, my placement is 10 lakh rupees average pay. Now over here, everybody is getting more or less 10. The median is 10. Median is basically beach ka value. We'll discuss this. Don't worry. I'm giving examples. So don't get worried that you're not understanding the details of it, because I'm not teaching right now. I'm just giving you a very basic broad overview. So even if there are some formulas or something you're not comfortable with, it's okay. We'll prove the formulas and all in the class. So median would be the beach ka value. The value so the fifth value, let's say, fifth or sixth value or so. I arrange the data in ascending order and I'm taking the beach ka value. So 50% students got below 10 lakh, 50% students got above 10 lakh. That is what median is telling you, but the average is 10. Over here, the median will also be 10 lakh because there are 9 times 10. All are 10 over here. So 50% students got below 10 lakh and 50% students got above 10 lakh. But one student, all the 50% students got above this 10 lakh value, but one student got 100 lakh salary, let's say 1 crore. Average is 19 lakh, but do you think 19 lakh is the average of the 10 students? Only one student got 100, all the other are 10. So don't you think studying this data, looking at the mean and the median, there is a difference? That is why always notice whether this, whatever placement record you're seeing, whether mean salary is being published or median salary or both. You will see most colleges outside India generally publish the median salary also. So understanding data, mean, median, mode, the standard deviation. So say suppose a stock is moving this way and there's another stock whose price movement is this way. So this way, the standard deviation is very high. So we measure standard deviation to understand risk. So dispersion, startups. Now what happens is we say 90% of the startups are going to be failing in the first year because they're very risky, new models, business models, etc. We don't know how it will work. But one startup could give you an extraordinary profit. So it is possible that most of the startup will be giving me losses over here, most startups, but there could be just one startup which might give me extreme profit. 90% startups here, but one startup over here. So understanding the data, understanding how the data is distributed, analyzing that data, because any decision that I make for the future has to be based on data. So statistics is going to be 70% of your work, right? So central tendency is your mean, median, mode and all. Dispersion is your standard deviation, etc. Hypothesis testing, a little complicated chapter, but again, it's new. So statistics, even if you've not done in 11, 12 as such, you'll have to just put in a little extra effort, but we will have to understand the formula. This is how we need to understand the difference between mean and a median. You can't mug up the formulas and do well, because the questions are going to be finance-centric, application-based. Now, when I'm looking at a hypothesis, let me give you a simple example. If any statement is given in finance, we need to check, analyze the past data, and give a confirmation whether that statement is correct or not. I think I'm complicating. Let me give you another way. So normally when there are these court cases and all, tariq pe tariq and all that. So what happens is the judge is not going to say whether the person is a culprit or innocent. It's guilty or not guilty. It's not guilty or innocent based on evidence. But the judge cannot say that you are innocent. The verdict is not that you are innocent. Similar logic we apply in hypothesis. So there is a statement given and we study the data. And based on the data, we will try to say that whether the statement is true, whether the statement is false, or we are not able to prove it false. So something of that sort. I don't want to get into details because I don't think I'll be able to explain in such a short while. It's a little difficult chapter, but very, very doable. Regression is when we try to plot those graphs. That let's say, for example, how the oil prices are changing and how will ONGC's share price change. So whether it's going to be upward sloping, whether it's going to be downward sloping. If oil price increases, does ONGC price go up or does ONGC price goes down? So how does a variable Y behaves on the basis of X? Again, linear regression is going to be from scratch. We'll have to prove the formula. We have to understand. It is not complicated. So one, we are not looking at calculus. We're not looking at trigonometry. We're not looking at congruency and similar triangles and all. We're not looking at geometry at all. We're not looking at complicated logarithm or all that. We're just looking at applying the basics. And predominantly it will be statistics. And even if you're looking at marketing, HR, etc., you have to understand past data to make future decisions. So looking at data, understanding numbers and data is extremely, extremely important for all profiles. So for those who are having a little bit of a challenge in maths, you'll have to work a little extra. You'll have to put in a little extra effort and it is doable. Even if you did not have maths in class 11 and 12, that is not a problem. But you have to work a little extra, right? So this is your quants. And second, of course, big data, there's a small chapter added. So big data basically, say suppose if I'm watching something on Netflix, so it is going to give me a recommendation that you may also like this. How does Netflix come up with that recommendation? Because there are people like me. So if I have watched 10 shows and you have watched 9 out of the same 10 shows, then my 10th show is basically a recommendation to you because our profiles are very similar. Because I'm liking the same 9 kind of shows and watching them, and you're also watching the same. So my profile and your profile is kind of working out. So there are clusters in which you can group people based on their likes, dislikes and all. That is also very advanced level of regression if you see. We're trying to find relationships between data, right? So big data and all, again, there is no numerical and all as such in big data, barely anything, because obviously you need softwares and all to do this. But the understanding, the basics, the understanding, you can call it big data, you can call it fintech, machine learning, AI, etc. So all those things are also there. So this is basically what your quants is all about. Big data is an easy small chapter, so don't have to worry about that we're getting into AI or tech or coding. There's absolutely nothing of that sort. It's just understanding the basics as to how it works, right? The concepts part. And that is again very small. So TVM probability is going to be barely like 10, 15, 20%. Big data is like 5, 10%, but 70, 80% is just statistics. Since we are talking about the level 1 curriculum, I want to give you an idea about the CFA at large. Level 2, again, what happens is it's more about regression, and we take this a little forward. And with a little bit of big data or fintech aspect, I would rather call it fintech, the application of regression and machine learning and all that. So bit of that, but the content is lesser in level 2 quants. Level 3, we do not have quants, right? So it's not maths that we are trying to study. We are trying to study financial mathematics, the application of numbers in finance. That is what we're trying to understand with quants. Also, I forgot to mention there are certain prerequisites that might be there. So the syllabus is this, the questions, the exam is going to test you on this, but some basics of probability which may not be over here, that might be a part of pre-reading material. So you need to know the concepts, right? So say for example, simple interest, compound interest, let's say is not there, but I'm taking calculations of money over here. So simple interest, compound interest, I have to assume you know. So obviously the pre-reading or the prerequisite that is there, that basics is not testable in the exam. You'll not have questions in the exam on that, but I'm going to cover that in the class. Conceptually, you have to know. You may be a little casual about the practice from that part, but conceptually you have to be strong to understand this. Next, we are going to discuss is economics. So we can look at economics in micro, macro and international. Some portion of economics is again in the prerequisite pre-reading material. We need to understand the concepts like demand supply, because if you don't understand demand supply, there are a lot of places where you'll need to know what is demand and supply and all. So exam will not test you on questions around demand and supply, but the basics you need to know. And don't worry, the basics will be covered. So let's stick to the discussion of syllabus right now. When I'm looking at microeconomics, predominantly I'm looking at, monopoly, etc., those market structures and all. Because say, for example, when I'm evaluating, suppose Relaxo shares, Relaxo slippers. So is there a monopoly over there? When I'm looking at an Apple, so because the hardware and software manufacturer is the same, so therefore that is what is probably helping them grab a larger market share. So it's not a monopoly, it's a monopolistic competition. Railways is a monopoly. So when I'm evaluating an industry, when I'm doing equity valuation, whether to invest in a company or not, when I'm looking at, acquiring a company or not, so how do I take decisions around that? I need to know what kind of market it is. Telecom, oligopoly. Because telecom, you have barely 2 or 3 players in India. I don't know how far Vodafone is going to survive, but any which ways, right? So what is the market structure? Because market structure tells me, because how, Jio did that pricing, it kind of gave throwaway prices, pay internet and everything to the people. And the prices in the market went down. Now they increased it because there is no competition. So yes, I can expect that Jio or Airtel kind of companies might generate huge profits in the future because there is not much competition. But if there is a lot of competitors, you can't earn a lot of profit because there's so much competition. So understanding that becomes important. Next, I need to understand macroeconomics. So for example, how the business cycle is, unemployment, inflation levels, the cycles in the business, etc. Because there are certain stocks which react that way. For example, as the market is going up or down, FMCG is not going to get so much impacted because you are going to be consuming food products and toothpaste or whatever. But automobile industry might get impacted if you do not have that much money. Discretionary spending goes down. Necessities pe to spend karna hoga. What you need, you have to spend on that. But the discretionary expenditure and all you can cut down probably. So understanding business cycles and all becomes important. And how does the monetary and fiscal policy work? So monetary policy is, how the central bank, RBI for India, Federal Bank for the US, how does a monetary policy work? Whether they're increasing money supply, reducing it. We've seen 2008 Federal Bank printed money like crazy. US again, the inflation levels get impacted because of the interest rates moving the way they are. Because of the interest rate in US and what the central bank is doing over there, investments may or may not flow to India. Startup space investment has dried up because of high interest rates, etc., for a time period. So how do you look at the business cycle? How is the central bank reacting? Central bank becomes monetary policy. The government, is the government doing a lot of infrastructure spending, which we are seeing in India right now? Or whether the government is increasing taxes or reducing taxes. So taxation is where the government earns money from. What is the amount of loan that the government has taken? Budget deficit and all. So that is your fiscal policy. That also impacts us. How? Because inflation levels. Inflation, interest rate, because if interest rate is very low, you will buy a house, you will buy a car. But if interest rate is very, very high, you will be concerned, you will probably not be able to afford a house or a car. One of the most aspirational purchases for an Indian is about, buying a house. And one of the bulkiest investment that you make is a house. So the house and car becomes extremely important, and interest rate becomes extremely important for that. When we're looking at international economics, let's say, we are talking about, let's say, geopolitics, and that has become extremely important today. Earlier, people were talking about just globalization. So much of production was outsourced to China. But now people are saying that no, the necessities, the basic production facility should also be in my country. In fact, I do not want to just buy from one country. I should have 2-3 alternatives. COVID times have taught a lot. So geopolitics, how does that impact us? Then we're looking at international trade and all, is custom duty, etc. Because the prices in my country will depend on the imports, exports. For example, the steel industry got impacted when people were not willing to sell steel in the country. They were rather exporting it because there was so much demand, and you were getting higher price by exporting it. So the government imposed export duty for a while. So how does that work? So the trade part and the currency, foreign currency and the currency related, all the calculations and all. Now, for example, Infosys and TCS get impacted by currency because Infosys, TCS is selling the services outside dominantly to US. In fact, their business cycle, their interest rate, etc. also impacts them. How much of business will you get? Whether there is a recession in the US or not. And because I'm getting all my income in USD, so whether I will convert my 1 lakh USD into 80 rupees per dollar, I will get 80 lakh rupees revenue. Or 82 rupees per dollar, I will get 82 lakh rupees revenue. So the exchange rate is very important when I'm looking at a company like an Infosys, TCS. Even for example, if you're looking at Tata Motors, I'm again going back to this talk. So when I'm looking at Tata Motors, it owns Jaguar, which is there in UK. So the pound, the exchange rate is going to be important for Tata Motors because Tata Motors balance sheet is made in India. That is made in rupee terms. So how do I incorporate Jaguar on my balance sheet? How do I convert a pound into rupee? So currency, exchange rates, etc. become very important. And this part is also going to be covered when we talk about financial statements and all. In Tata Motors financial statement, you'll find Jaguar and all, right? So currency becomes extremely important. So we need to understand economics in a lot of detail, and we've seen, Greece going bankrupt, and there's so much of risk when you're looking at the international, and there's so much of globalization. I mean, everybody is probably working across borders because of internet, because of the kind of logistics we have. Just imagine you order something today and you get something tomorrow in Amazon. Just imagine the power of logistics, the amount of products available, the amount of trade, the magnanimity of trade that is going on right now. It's humongous. It's very interesting. Right? So economics becomes extremely important to decide, for example, what kind of market it is, Relaxo, Apple. So we need to understand the basics of economics to make forecast also. Even when I'm investing in a company, I'm not liking Infosys. Let's say if there is a US recession, I would not want to buy stocks of Infosys, for example. So I need to evaluate. I need to understand. Economy is extremely important. Even a small shopkeeper would be having some idea, because if the market is not good, he knows I'll not be able to sell much. So I should not buy a lot of inventory, because if I buy a lot of inventory, kharab ho jayega. The stock will get outdated, obsolete. Just imagine even a sweet shop has to forecast that how much sweet I'll be selling today, how much to prepare today, because it's a perishable product. It might go stale. So just imagine there's so much of economics that already use in our day-to-day lives, right? And when we're looking at the level 2 curriculum for economics, again, the content goes down quite significantly. We have more of currency and one chapter on growth and all. So the content for level 2 is very minimal. Level 3, the content is more aligned with portfolio. But again, we need to understand, for example, whether to invest in emerging market or not. Emerging market, Brazil, Russia, India, China, becomes a little risky. So it will be from the portfolio perspective, but you will not have economics as a subject when you're looking at level 3. And there is some pre-read about demand supply, which I've already mentioned. So this is economics for you. Next, we're looking at financial reporting analysis, which is what the non-commerce students are a little scared of. But to my disappointment, I was thinking of not saying this, but anyways, to be very honest, to my disappointment, I've seen commerce students also having a little bit of a challenge when it comes to the basics and the concepts in terms of, doing a depreciation calculation or something. Now, firstly, you need to understand, of course, non-commerce students will have to work a little extra, economics, honors, and non-commerce. But everything, as I told you, will be from scratch. Second, what you need to understand is we're not here to prepare accounts. We're not here to make annual reports, prepare balance sheet, PL account, etc. That's not what we're looking at. If I'm looking at an Asian Paints annual report, I should be able to see that, okay, last year these guys this much, this year their cost has gone down, their profit has gone up, taken a lot of loan, they have repaid something, they've built an asset. So I should be able to analyze, okay, the cash flows have gone down, but there's a huge investment they have made. So I have to be able to analyze, understand the report, and that could be from multiple perspectives, whether I'm planning to invest in Asian Paints or not. It could be from the point of view that, let's say, whether a Tata Motors should be acquiring another company, or how do we look at the annual report of a company to give loan to Adani or not. So there are so many questions that is out there. So how do you analyze an annual report? In fact, now forensic financials are also there, like the Hindenburg report that they did. I'm not getting into the validity of the report and the claims and all they've made. That's another question altogether. But to understand that, right? So that becomes important. For example, in fact, I don't know if you've seen that Jack Ryan, CIA, there's a series on Amazon Prime. It's quite a good one. So it starts with, you trace the money where it is, and then you understand, okay, this is a terrorist activity happening, etc. And that's how the season goes around. Anyways, coming back to it. In fact, Satyam scam we have seen in India earlier. Now we've seen a list of scams like Yes Bank and all of that. So how do you analyze the annual report? How could you forecast that Jet Airways is going to go bankrupt? Can I do that? So how do I look at the annual report? Whether I'm able to read, understand, analyze the annual report, that is the question over here. Preparing the annual report is a financial reporting team's job, the accounting job. And even when you're looking at accounting, people do not sit and pass journal entries when you're looking at the financial reporting bit. But here we are looking at financial reporting analysis. So we need to be able to understand how to read, understand, analyze the annual reports, right? So the introduction will be, what are the sources of data? So even if you go to an ITC's website and you go and check the investor presentation, their annual report, they will also file quarterly report. Since it's a listed stock, ITC you can buy and sell shares. So it is listed. So there will be some SEBI regulations, Stock Exchange Board of India. You have SEC in the US. So you could have a lot of filings and regulations over there. Now there is a Companies Act. So because of that, you have to file some details and data and all. So MCA website pe you can find all that, Ministry of Corporate Affairs and all. So basically, what are the sources of information? Where all I can collect information? That is what I'm discussing in the introduction part. Then to understand the income statement, basically how much did I sell? What is my cost? What is my profit? Obviously, it's not going to be that simple. Then the balance sheet. What are the assets? Land, building, plant, goodwill, how to include or not to include goodwill, all that we will see. And what are the liabilities, the loans and all I've taken. Then you have your cash flow statement. I might be making a lot of sales, but what if I've not received money for it? I'm booking sales, but I'm not showing the money. So there's a lot of manipulation of accounts happens this way. That I'm showing that I've made so much on sales, but they're all bad debt. They will not give me the money back. Bank loans, NPAs, we've seen so much of these things happening. So understanding all that. And then the ratios to analyze all this, right? Debt to equity ratio, net profit margin. So what percentage of my sales is profit, what percentage cost, etc. So analyzing the numbers and all of that. Then we actually get, so this is going to be fairly easy. And then we get into the specifics, inventory. So there's a chapter on inventory, your closing stock, opening stock, etc. The inventory that you're selling. You will have a chapter on assets. So you can have patent, copyright. These are intangible assets. Nowadays, when we're looking at so much of IT companies and all, everybody talks about, asset-light companies, big basket and all. You will not own any store. Uber, Ola do not own any cars, but they have intangible asset, the customer base, the technology, etc. So how do we look at those intangible assets as well? Or heavy plant machinery? How do we put the valuations on the balance sheet, right? Say, for example, something became obsolete. Now, how do you value? Suppose I was showing some machine at 100 rupees on my balance sheet. Now the value of that machine has come down to 20 because of some technology change. So how do you record that? How do you recognize these losses? How do we analyze all these things? If a company is becoming dated, redundant, if a technology is getting redundant, how do we approach that? Then liabilities. Companies might take loans, so there is liabilities. Pension liabilities, companies and all have to pay a lot of pension for their employees, etc. So how do we study those liabilities, right? Leases. So when I'm taking lease nowadays, when you're looking at business models like WeWork and all. So there is WeWork, the startup. So there are so many cases wherein you're not buying the office space, but you're leasing out. You're not buying the heavy machinery, but you're taking the machinery on lease because everybody wants to be asset light. You don't want to put in that huge bulky investment, right? So all those things we study. How do we read the annual report and analyze that? So how do you compare the annual report of a DMart? DMart is a store. DMart owns all the stores. DMart is a hypermarket, grocery, and when I'm looking at Reliance Fresh, they do not own the stores. So their balance sheet PL will be very different because DMart does not have rent cost, but Reliance Fresh will have rent, but DMart will have a huge asset. Reliance Fresh will not have that huge asset on the balance sheet. So how do I analyze the two together? And the treatment of taxes. Now it is not income tax report that we are filing or something. Taxes is basically, how do I save taxes? How is the taxes going to be impacting my balance sheet? I'll give you a simple example. What if there is a company that does business in India and it does business in 3 other countries? In those 3 countries, let's say the tax rate is 20%. Over here, let's say it is 25%. Now what happens is, what if my sales is growing in those 3 countries? On an average, I'm paying 20% tax over there, but over here I'm paying 30% or 25%. So if I'm growing more in those countries, my average tax rate will come down. But if I'm doing more sales in India, my average tax rate should go up. And a lot of other details and treatment, but we will stick to this much. So that way we are going to be approaching taxes in terms of the impact on balance sheet PL. Right? We're not going to be calculating taxes and tax laws and all, because anyways, we're looking at finance and a very, very global designation. You can't study any one particular country's tax laws, right? And reporting quality. So how is the reporting quality? Are you overstating your sales? For example, at times companies will come up with a lot of sales and offers and all that in month of March because they want to show that I have done so much of sales. And then in the month of April, there will be a lot of sales return. So whatever, at times even Flipkart and all these guys, you must have seen that a lot of orders are placed and then they cancel those orders because they are overbooked. They take orders, they want to show that this is the amount of sales we've done, but they at times may not book. A lot of times what happens is in the month of March, they will come out with offers and they will do those sale on approval basis. They will inflate their sales. They want to show a higher sales for the month of March, that see, we've done this much sales in this year, right? But ultimately what happens in April, all that sales is going to be returned back. So that is not actual sales. So what is your reporting quality? Are you properly maintaining all the data? Satyam was not, that was a scam, right? What is the quality of your reports? What is the quality of your PL account and all? So say for example, if I'm using a machine for 5 years, I'm going to depreciate it over 10 years or 2 years. So do I allocate that? Suppose I'm buying a 50,000 rupees machine. So do I show 10,000 rupees cost for 5 years? 10,000 will be total 50,000. Or do I be more conservative that no, I may not be able to use it for 5 years. I may be able to use it only for 4 years. So let me recognize 12,500. So basically the idea is, do I want to show more income fast or do I want to conservative? I want to acknowledge more costs at the beginning. The non-commerce students will find it a little bit of a challenge over here to understand right now, but once we get into the details, that'll be fine. And then the financial statement modeling is basically how we work is that suppose I have got the last 5 years data, sales, cost, etc. I will make certain assumptions in order to forecast the next 5 years. Obviously, how do I forecast what will be my sales next year, cost next year, profit next year? That will be based on the past data and past ratios and all, right? So I will analyze my financial statement in order to make projections, forecasts, projections. That is financial statement modeling. It's going to be very basic. We'll just try to understand how to go about it because the details are, going to be done on Excel and all that. And level 2, you'll have financial statement modeling chapter and all. So it's going to be very, very basic what you're going to be doing over here. So, but very interesting. So this is your financial reporting analysis. It's going to be a little lengthier in terms of volume. So quants is there, economics, FRA is also quite a few number of chapters are there. Some basics you'll have to do beforehand, like understanding the basics of accounts and all. Obviously, all that will be done. We'll do the classes and everything. You can do a little less practice over there. In the prerequisite part, this is your syllabus. This you have to be thorough with. Level 2 gets a little complicated, but that's again from scratch. So it's not that commerce students have studied that part. So, in level 2, we have something called multinational operation. At Jaguar incorporating, Tata Motors incorporating Jaguar on the balance sheet. Multinational operation. One is going to be on pension. One is going to be on intercorporate investment. So say for example, Grasim holds Ultratech and ID. Grasim owns Ultratech's share. So how do I look at Grasim's balance sheet only textile and Grasim's balance sheet including the cement of Ultratech? So that business combination. So intercorporate investments when multiple companies are investing in each other. And then some analysis and all that is there in level 2. Level 3, FRA is not there. Right? So this is your financial reporting analysis. Our focus is on understanding level 1 curriculum, but I'm just giving you a brief about level 2 and level 3 as well. Not very difficult, but you have to conceptually understand. Mugging up won't help. Now we are moving to corporate finance. They're calling it corporate issuers or whatever, but I want to call it corporate finance. That is what it is. See, when I'm investing in the shares of ITC, that's an equity subject. I am not inside ITC. When I'm working inside ITC's finance department, I am the one who's taking financial decisions for the company. That is corporate finance. So basics is basically what is a proprietorship, what is a partnership, etc. Very basic, what is a company and all. Very easy. Next is, I'll come to corporate governance in a bit. Next is your capital investment. So if I'm going to lay down a factory and it's going to cost me this much, next 3 years I'll have to spend this much money, invest this much money, and 7 years I'll make these cash flows, whether or not to take a project. I'll give you a very simple example. There is this air conditioner over here. It's become a little old. My question is whether to get it repaired and keep using it for the next 3 years, or should I replace it? Because if I replace, the cost is going to be much more than repairing, but I'll be able to use it for 10 years and there will be savings in electricity because newer technology generally is more energy efficient. How do I decide between the two? So capital investment decisions. So this is a very simple example, household example that I've given you. But when you're looking at a company, whether should I replace this technology, this machinery, where to invest my money in, how to evaluate between two projects. Suppose I have only $20 million to invest. Now, project A is also requiring 20 million to invest and project B is also requiring 20 million investment. Which one should I take up? So capital investments. Capital structure. So Adani has got a huge amount of debt on its capital structure. So how much equity, preference, debt, etc. do I want to have in my capital structure? What is most optimal? Say for example, right now if interest rates are very high in the market, I don't want to take too much debt, I'll probably take more equity. But if interest rates are very low in the market, I'll probably be comfortable taking a little more amount of debt. So how should the capital structure be? How do I evaluate that? That part is there. Then we talk about working capital. So when I'm looking at the balance sheet, let's say, I'm looking at current assets, current liabilities. A lot of times what happens is because of poor liquidity, when there is market crunch, suppose you made a lot of sales, your customers are not paying you money, but you have to pay to the suppliers. Air India, we have read so much about the working capital challenges that these guys are not being able to pay interest on time, pay salaries on time. How will the company function and move forward in the future? So working capital, to run your business, the capital that you need, not the plant machinery or aircraft and all, but the basic money that you need to buy inventory, to buy fuel for your aircraft, to pay salaries, etc. So how do you go about doing that? That is your working capital and liquidity and all. Business model is an extremely interesting chapter. So business model is understanding what is the entire business model. For example, is it a subscription-based model? What is Google's business model? You're providing so much of facilities for free. It is an advertisement-based model. A magazine which is providing you subscription is a subscription-based model. So how do we look at different business models and all in Oyo Room or an Ola Uber, or so much of tech companies are there, or they are proper brick and mortar stores. So what are the different business models? To understand business model, because how do I forecast cash flows? How do I take financial decisions if I do not understand the business model of the company? So business model is a very interesting chapter actually. There's some relationship of this with equity. We'll discuss the subject. Corporate governance is extremely important. We have seen Bharat Pay issues happening, Ashneer Grover and all this. Then we've seen a while obviously, but Cyrus Mistry versus Ratan Tata Group. Cyrus Mistry was ousted out. He was removed as the chairman, etc. If I were to take another example, in fact, Uber also did not have a CEO for a good amount of time. Now what happens is I'm not running ITC. I do not have the time to run ITC and I'm obviously not a part of the company to run that. But I own the shares. There is a management, CEO, CFO, management, etc. running the company. We need to make sure that the management is running the company for the benefit of the shareholders to take the company forward. They're not using company's money and resources for their personal requirement and all. So corporate governance, how is the governance structure of the company? Is there any loophole? Is the company being governed properly? Are the people working for the benefit of the shareholders? In fact, we also want to see that, you cannot even defraud your customers and all when you're looking at a Maggie incident with Nestle, because ultimately it brings a lot of reputational challenges. So we need to make sure that your customers are happy, your suppliers are happy. So corporate governance, company's governance, because the owner is not the one who's running the company. The management is running the company on behalf of the shareholder. So corporate governance becomes extremely important. This is corporate finance, relatively easy subject, not difficult, very interesting. Level 2 will have a little bit of corporate finance also, companies restructuring, mergers, acquisition, and those kind of things. Level 3, we don't have corporate finance. Level 3 is not going to having a corporate finance and quants and economics per se. Economics is still there in terms of application. Level 3 is more focused on the portfolio. So I'll come to it, but you understood corporate finance broadly. Next, we're looking at fixed income. So now when we're talking about investment, so let me just ask you a simple question. When I'm looking at investment, so what would you be investing? What will be the assets that you own? So one, people own houses and the house they live in, etc. They own gold, jewelry and all of that, right? Second would be you do a lot of fixed deposits and all that, those PPF account, provident fund account, because you get some tax benefit. So you do those FDs in the bank and bank account and all of that. And then you do equity investments. So you might be buying shares or you might be buying mutual funds. Mutual funds sahi hai, right? So basically when you're looking at investments, normally we divide it into 3 categories. So one is your equity. You can either analyze the companies, buy ITC shares and whatever yourself. I'm very happy about my ITC's investment. Anyways, so that is one. Second is you can buy through mutual funds and all. Next, when you're looking at FDs, generally through fixed deposits and all, companies also issue bonds. So that bond related calculation in FDs. So when company is taking loan, we can invest in the company's bonds, debentures, you might have about in class 11, 12 maybe. So that is all your fixed deposits and all those calculation. And the third could be your house, that is real estate. It could be gold, that is like a commodity. Then it could be private equity, startups. People have started investing in startups also. So all that is categorized under alternate investments. So these are your 3 subjects which we will discuss now. Fixed income is obviously numerical in terms of the subject. It's obviously very, very numerical. So first we understand terms, what are bonds, government bond, corporate bond, and all of those basic terms and all. This is very interesting, your valuation. So value of anything is the present value of future cash flows. This is what I'll teach you in the first class when we do time value of money. So when I'm looking at the valuation part, so if I have invested, say suppose I've done an FD of 100 rupees for 5 years at 8%. All right, let's say. So basically what will happen is that you will get 8, 8, 8 and 8 in the next 1, 2, 3, 4, 5 years. And in the 5th year, you'll also get your 100 principal back. So you'll get a total of 108. Now, let's assume you cannot break this FD. You have to wait for 5 years, let's say. Now what happens is, what if the interest rate in the market changes and drops to 6%? Are you happy or sad about it? You're happy about it because I invested in the FD when the market rate was 8%. The FD will give me 8, 8, 8, 8. Had I not invested at 8% for 5 years, today I can invest the money only at 6% rate. But if the rate increases, you don't feel happy because you are not going to get 9%. You have in fact blocked your money at 8% rate for the next 5 years. So how do we do these calculations when the interest rate changes? How do we calculate this fixed deposit or bond or whatever you want to call it? And how does the interest rate fluctuate? And all those calculations and everything is going to be a part of valuation. Right? And how does that calculation fluctuate and how the interest rates are fluctuating and all of that? So the risk, that is interest rate risk. Now, when I'm putting the money in a government bond, I know that the government is not going to default. The government has to pay me money. Even if the government does not have money, they're going to print the currency. They have the central bank. So the government is not going to default. Obviously, there'll be a problem because if the government is printing too much money, there'll be inflation. We'll discuss how it works because if the government is printing money, distributing money for free, obviously things are going to get more expensive. There's more money in the market. There's so much money, people will buy more stuff, etc. We'll get into all that when we study economics. A lot of interrelationship between subjects will be there. It will be very interesting to see. But when I'm giving a loan to a company, when I'm investing in a company's bond, debenture, when I'm giving loan to the company, banks give a very bulky loan to the company. But at times company issue bonds in the market. So normally in India, we'll find 10,000, 50,000 or 1 lakh rupees bond. So there are lakhs and lakhs of people who might have, purchased 10,000 rupees worth of bond and company gets 200 crore, 500 crore. Adani's got huge loans and all. That is credit risk. Whether this person will be able to repay back the loan or not. With the government, I'm not scared because they can print the money and give you back. But with the companies, I'm going to have a challenge. That is credit risk. Whether Malia will be able to repay the loan or not, right? So that is credit risk. And there's something called mortgage-backed securities. It is a very interesting topic, but I'm not sure if I'll be able to explain to you in a very short manner. But I can tell you 2008 recession, the US recession, the global recession that we saw in 2008, experienced in 2008, one of the major reasons was around the mortgage-backed securities. So in short, when you take a home loan, if you're not able to repay your home loan interest, principal, etc., ultimately the bank can take away the house from you. That is why these loans are known as mortgage loans, because the house is mortgaged, girvi rakha hai, right? The house is mortgaged over here. So mortgage-backed securities is something around that, and how it led to the US crisis and all. There is a lecture on asset securitizations well posted on YouTube. You can check that if you want to. It's a very interesting lecture, but I'll not be able to explain in more detail right now because I'm just giving you an overview of fixed income. But this is more around those fixed income securities, home loan related, home loan backed securities in short. And it's very interesting concept. So this is your fixed income. Level 2, level 3 also fixed income will be there. Again, the volume of level 2 fixed income will go down. Level 3 will be there as much as level 1 may be. But in level 3, we are going to talk about fixed income portfolio. For example, an insurance company. Now, how will they manage their fixed income portfolio? See, understand, an insurance company has to manage its investments in such a way that they are able to pay off the policy holders. For example, if somebody had an accident or something, if they have a claim, insurance company has to make sure they are able to pay for that claim. Right? Pension fund. So a pension fund has to make sure that whoever has retired, I'm able to make the pension payments to them. So if I am making fixed income investments, how do I make that? How do I manage? So level 3, it's going to be fixed income from portfolio perspective. Level 2, we'll still study fixed income, option, embedded bonds. There's quite a few things. We'll be taking this forward. In level 1, basically what happens is there are new terms, new subjects. So you're building your base. Level 2 takes it forward. And level 3 kinds of puts it together in the form of application, in the form of, looking at a portfolio at large. So fixed income is going to be there in all the 3 levels. And this is a slightly difficult topic. Students find it more confusing and all. If you're comfortable with time value of money and money calculation, fixed income will be easy for you. But it's a very interesting subject. Of course, a bit numerical and all, very interesting. Next is equity. This is one of the favorite subjects as well. So basics, what is equity, what is preference shares, the basic terms and everything. So a lot of basics and all we do. Then we talk about index. So how is the Nifty calculated? So when you say market is going up, market is going down. So Nifty is basically the sum total of top 50 companies of India. So Nifty is trading at 18,000, 19,000, whatever be the value. So how is it went down to almost 8,000 levels in COVID? Nifty is representing the average of 50 stocks of the country. There are a lot of different indices. Bank Nifty. So Bank Nifty represents the banking stocks on an average. So how do you calculate those indices? What are the different kinds of indices? All those things. Market efficiency. Now, how can you make, everybody is trying to make money in the markets. So is there a mispricing in the market? Do I think that the company is trading at, let's say, 200 rupees a share? It should be priced at 300. How do I trade on that? How do I make money? Should I look at those charts, prices, patterns and trade on the stock? Or do I look at, let's say, analyze annual reports, balance sheets, PL, and then figure out, no, this company is going to do very well. Look at the economics of the company, demand of the company, look at the product, look at the monopoly that they might be able to create, etc. So I'll analyze the industry, economy. Okay, if Ayushman Bharat scheme is coming out in India, let's say free healthcare by the government, will Apollo Healthcare stock price go up? So I'll analyze all those things. So whether I'm looking at that kind of analysis, whether that will work, whether I can make money out of it. There are people who work on inside information. So how efficient is the market? Whether the share prices in the market are correct or not, etc. So all that we are going to study in the efficiency part. Industry company analysis, very practical, very interesting. Demographics, politics. So because there are more people moving to online shopping and ready-made garments, which companies will do well? For example, in India, we have Aditya Birla Fashion. That company holds Van Heusen, Alan Solly, Louis Philippe, etc. All these brands are owned by this company, Aditya Birla Fashion. In fact, Van Heusen, in order to compete with Jockey and Lux and Rupa, these people started with the innerwear brand also. What is the industry like? How do you analyze the company? How is it increasing its presence? They've got their lifestyle pantaloons also and all that. So what is their presence in the market? So you analyze the industry, you analyze the company, you evaluate whether to not to invest in the company and all. There's a couple of additional chapters also over here. It's very interesting to be able to make a forecast based on, because you have to understand the business and the industry in order to forecast how the industry or how the company is going to do, right? And then the valuation. So how do I evaluate? How do I look at the valuation of a share? So maybe based on dividends, okay, this company is giving so and so dividends. So what should be the value of the share based on that? Or this company is generating so much of profit, so much of cash. So how do you look at the valuation of the company? So if I'm looking at the valuation of a company like, let's say, Coal India. So if I can value that how much coal reserves the company has and what is the price of coal, so based on that, I can do the valuation of the company Coal India, asset-based valuation. So please don't get worried that I'm going a little fast over here. I'm trying to explain like 90 learning modules or something like that in an hour, right? So the idea is not to understand everything. The idea is to look at the syllabus and understand the relationships between the subjects to just get a glimpse of what the syllabus is like, what all I'm going to study. So when I'm studying fixed income, I know there are fixed income is there, equity is there, alternate investments. So all the investments that we people do, these are the subjects we're looking at. Right now, I'm studying the fixed income part of all the investments we do. So that perspective you should have, that, that macro view, overview you should be having. So valuation is very interesting. Equity is there in level 2. Level 2 may the valuation over here, you'll have, let's say, one chapter in valuation and which has like 4 methods of valuation. Level 2, these will become one chapter each. So level 2, we have equity, decent amount of equity. And level 3, again, equity will be from a portfolio perspective. How to create an equity portfolio. Right. So it's going to be more portfolio perspective. We'll get to it, but that will be level 3. So equity is there in level 3 also. It's fairly simple, less numerical, and it's a very interesting chapter. And it's not very difficult, normal. Now, when we're looking at the third category of investment, fixed income, equity, and alternate investments. So we've discussed commodity, gold. How do you invest? Say, for example, I think that oil prices will go up. How do I bet on that? Commodity. So there are ways in which you can do that. Obviously, I'm not going to fill up bottled oil and bring it to my house. So there are ways. There are something called derivatives that we use in order to do that. So that is there. Real estate investment. In fact, along with real estate, you have farmland where people, grow crops, etc. Tax advantage might be there. Land appreciation might be there. Timberland. There are people who invest in timberland because they will be, they'll cut trees and use that timber to sell, and then they'll again reforest it, of course. But that is also there. Private equity is like startups and all. There's more, but just giving you a basic idea. So people can invest into startups. I can buy Zomato shares because Zomato is listed. The share price is available, but I cannot buy Swiggy's shares. Swiggy becomes private equity. It's not public equity. Zomato is public equity. I can buy the shares of Zomato on the website, on Zerodha, or whatever Demat account and whatever platform you're using, right? So hedge fund is like Amir Log Ka mutual fund, rich people's mutual fund. Have a lot of restrictions because see, a common public can invest something as low as 500 rupees in a mutual fund also. Government cannot allow our money, common public's money, to get invested into a fraudulent scheme, to be a fraud or something like that. So that is a challenge. Hedge funds, what happens is, there are people who can take a lot of risk, not the common public. High net worth individuals, rich people. These people want to take a lot of risk. They do not want that much restriction with mutual fund and all. Because mutual funds mein the common public is investing, so the government cannot mess up. Common public ka paisa you can't touch. Right? Like that. A lot of restrictions are there. They cannot take a lot of risk and all that. But hedge funds can take a lot of risk. So only rich people with a certain level of net worth and all can invest in hedge funds. And hedge funds will have very less restrictions. So they can trade, invest, etc. because they can make that kind of money. They're looking at that. And now obviously we're looking at NFTs and cryptocurrency and all that. So we'll have a glimpse of digital assets over here. Earlier, for example, alternate investment used to be one big chapter. Now they've broken it into very small 5-6 chapters. Level 2 also has alternate investment. We have a chapter on commodity, a chapter on real estate, of course, more detailed hedge fund, etc. in level 2. Level 3, we have one chapter on alternate investments, but that is from the perspective of a portfolio. That out of your entire portfolio, all the assets you're holding, I'm sorry, I'm coming to portfolio next. I'll explain what a portfolio is. But when I'm looking at all the assets held together, so how do I look at how alternate investment fits into my portfolio? So if I have 100 rupees of investment, how much out of 100 should be equity, fixed income, alternate investment? Out of alternate investment, should I invest in commodity or not? If inflation will be high, gold will increase, right? Real estate, should I invest or not? Because real estate, you can't just sell it whenever you feel like. It's illiquid. We'll learn terms like what is liquid, what is illiquid, what is liquidity risk. So don't worry about it. I know that there would be a lot of terms which you may not be familiar with right now. We'll discuss all that. So don't worry that way. Right. So how to form my portfolio, how to form my assets. So for example, a 60-year-old individual may not want to hold real estate, but a 60-year may actually be owning existing real estate because he might have paid off his home loans and all. So how do we structure the alternate investments as a part of the portfolio? That is in level 3. Level 3, alternate investment is low, and fixed income, equity, alternate investment, everything is from a portfolio perspective in level 3. Anyways, let's stick to level 1. Now, when I combine all of this, fixed income, equity, and alternate investments, how does my total entire portfolio look like? That is what your subject portfolio is about. Now, I could be constructing a portfolio, let's say I'll just come to it. So overview, we'll talk about what is portfolio and all that. A portfolio, I might need a portfolio to be made. A 20-year-old individual's portfolio, he can take a lot of risk because he's going to be earning for the next 40 years. But a 60-year-old individual cannot take a lot of risk because a 60-year-old individual is now retiring. Now he has to take out money from his portfolio to manage his expenses. So portfolio is your entire net worth, all the assets, the house you live in, the gold you own, the fixed income, FDs that you have, the equity shares, mutual funds. If you have a business, that value, that asset, everything is a part of your portfolio. Now, how much risk can I take? For example, somebody who's a stock trader, in his personal portfolio, he may not be able to take a lot of risk because his business is risky. Or somebody doing a risky business, he should invest more into FDs, because what happens is, what if the business is doing badly right now? So at that point of time, my FDs might take care of it. So normally when I look at portfolio, I don't want to invest in assets where both will increase or both will decrease at the same time. Because what happens is both are increasing or decreasing. So my movement is very, very extreme. The standard deviation will be high. We'll do that in quants. You will find relationship between the subjects, right? Now what happens is, in order to reduce risk, I want to invest in assets in such a way that when one goes down, the other probably goes up and they balance out each other. Like normally when there is a market crisis, equity is going down, markets are doing badly. At that point of time, normally, generally gold is going to go up because people are scared, people go gold. Right? So they will balance out each other. So instead of two assets moving in the same direction this way, they balance out each other and they will move in an arrow direction. So this is more risky or this movement is more risky. The first one, right? So therefore what happens is we understand risk. So that is why, you would have heard, do not put all your eggs in one basket. We want to diversify our investments and all. We want to, so that if there is a loss from one asset, there is a profit from the other asset and we are able to manage that. So this is your IPS, investment policy statement. So how does a 20-year-old individual invest? How should his portfolio look like? What amount of, so if I'm a salaried individual, I might be able to take a lot of risk because I know a sum of money every month. But if I'm a business guy whose cash flows are very volatile, I mean, my business might do well this month, I might have more profit, less profit in any month. So in that case, I want to take less risk with my investments so that if there is a problem with my current income, my business income, I can fall back on my portfolio. So planning that for a 20 or 60-year-old individual. Banks also do not keep the money at home. The banks also invest. How do they manage? So overview, understanding that and understanding biases. Like for example, if you have a 200 rupees share and suppose the price goes down to 180, you might panic or you might say that no, it has gone down, I'll buy again even more. And then if it goes down to 160, you want to buy it even more. And you want to hold the stock till it comes back to 200 because you want to recover your loss from that stock only. There are a lot of biases because ultimately we are all human beings in the market. So there is a lot of emotion that plays. So what are the biases that we people have? Right? So we study that because it's very important to understand the biases. Psychology of Money, for example, is an amazing book to read around this. So biases, I could give you another example. So say suppose I like a stock. Now, there are 10 research reports on that stock. I like ITC. I'll read 10 reports. Out of that, the 6 reports which say ITC is good, I will say, this report is good. The 4 that say that ITC is not good, I will not believe those reports and I'll find excuses to discard those. So I'm biased towards my previous judgment. If I'm not biased, if I'm very rational, I will look at all the points. Okay, why is he saying good? Why is he saying bad? And I will take a very balanced decision. But you always have emotions at play. So understanding that in order to take decisions, business decisions and all, it becomes important. CAPM is an exceptionally interesting chapter. So it is a formula basically, RF plus RM minus RF beta. If I'm investing in a bank, I'm let's say demanding a 7% rate. If I'm investing in a Tata Motors, let's say I'm demanding a 12% rate. If I am going to invest in, give me a very risk, let's say I'm investing in DMart, Avenue Supermart is a company. I think it's less risky than Tata Motors because if the market is good or bad, people might buy less cars, etc. But people have to go for grocery shopping and all. So let's say I will demand only 10% rate. More risk, I will demand more money. Less risk, I will demand less return. This is comfortable. So how do you calculate these rates is what we discuss in CAPM. It's a very long class. It's a very interesting class where we derive the formula and we move, the calculation of this, how to calculate the risk of the company, how to calculate what amount of return do I need. Because if I don't calculate this, how do I do the equity valuation? Bombarding you with a lot of information. But for example, when I'm looking at a stock, I have to say, okay, this stock can generate this much money in the next 10 years, this much profit in the next 10 years, this much cash flow in the next 10 years. I have to discount those cash flows today, right? 100 rupee today is not 100 rupees after 5 years. So at what rate should I discount? So understanding the riskiness of the stock, understanding the returns I need from a stock, from a market, from my portfolio, etc. All that is CAPM, that formula. It's a very interesting portfolio, right? And constructing portfolios, I've already told you. Risk management is a relatively easy theoretical chapter. So in order to manage risk, you can take insurance, let's say, right? One thing I forgot, portfolio is going to be there decently well in level 2 also. Level 3 is going to be all about portfolio. Mostly about portfolio. You'll have equity, fixed income, alternate investments, etc. But from a portfolio point of view, you are going to apply equity, fixed income subjects and all from a portfolio perspective in level 3. But portfolio is there in level 2 also. So I'll not get into more of risk management here. Let me introduce the next subject and talk about the risk management part. When I'm looking at derivatives, now let me give you an example because it's very difficult to explain these four. I'll take maybe a few hours just to explain these four terms. Superb. I mean, I think this is one of my most favorite subjects. It's very interesting. So suppose I'm scared who's going to take care of my family after I'm dead. So what do? I buy a life insurance. I'm scared hospital bills are going to go up if I fall ill. What do? I buy a health insurance. Similarly, there is a lot of risk in the business also. Suppose if the rubber prices are going to go up, MRF tire is going to get affected. Madras Rubber Factory, that's MRF. So MRF is going to get, their profit margins will go down because their raw material is rubber. So how do I manage that risk? Infosys, TCS we had discussed. These guys are scared about the rupee dollar prices fluctuating. So how do I manage the risk of that rupee dollar fluctuation? So we can buy insurances and all when we are looking at life insurance, health insurance, property, fire insurance, etc. But how do we manage these kind of risks in business? You use something called derivatives. So for example, suppose I have imported some goods. Okay? I have imported some machinery from China. Now I have to make the payment after 3 months. Today the rupee dollar exchange rate is, let's say for example, 80. I am scared, what if this becomes 82? Because I have to make $1 lakh payment. So if today I make the payment, I have to pay 80 lakh rupees. But if after 3 months, what if the exchange rate is 82? I'll have to use 82 lakh rupees to buy $1 lakh and make the payment. What I'll do is I'll do a contract with the bank today that I will take $1 lakh from you after 3 months at this so-and-so rate. That is a forward contract, right? So I will fix the rate today so that there is no risk in future. There is no fluctuation in future. So all the risk management that we do is primarily by using something called derivatives. Extremely interesting, forwards, futures, options, swaps. I'm scared of interest rate going up. Suppose I've taken a 5-year floating rate loan. Matlab whatever is the interest rate in the market, I have to pay interest based on that. What if the interest rate increases next year and I have to pay a huge amount of interest rate? How do I manage those things? So we use these kind of derivative products, extremely interesting to manage those risks and all. Even if somebody wants to take a bet, speculate. Suppose I'm expecting that Nestle's share price is going to go up. How do I, without buying Nestle, how can I take a bet on that? So all those things you'll be able to do with derivatives. It's a very good subject, but it takes time for you have to understand the terms. So it's very new, basically. So that's why I cannot get into more details about it, but that is derivatives. It's there in level 2 also. It's there in level 3 as well, because risk management, how do you manage and use derivatives? In level 3 again, how do you use derivatives to manage your portfolio risk and all that? That way we are going to be studying more. But derivatives is going to be fairly numerical actually. And the last subject for you is going to be ethics. So ethics, basically when I'm looking at level 1, standards is going to be there in all the 3 levels. So same 7 standards are there in level 1, level 2, level 3. Extremely important subject. It is subjective, it is not numerical. And it's not that the entire curriculum, all the 10 subjects is very numerical, because there are a lot of questions where they'll be asking you conceptual questions, which is not number crunching. But you have to know the concept. If you're mugging up, CFA is not going to work. You have to understand very well, very thoroughly. Now when I'm looking at standards, there are 7 standards. Any professional exam or any professional body you see, doctors also take a pledge, lawyers take a pledge. They have to be ethical towards, the patients and the clients and all that. Similarly, finance people also need to be very, very ethical. Now, Satyam scam or Yes Bank and all of that, we see there are so many scams that are happening. That is very unethical. Now, suppose you're working in an XYZ company, you called me up and you told me that, my company, this much sales we have done, this much we have done, and that data is not available in public. I use that information and buy the shares of the company because I got inside information from you. That is unethical and it's also illegal. So how do we go about it? So all those standards are there to, train you or to teach you as to what is good or bad, if I were to say so. And the questions in the exam are like, they'll give you a situation that, this person was there. He heard a CEO talking in the lift that his company was doing very badly. Then this guy came out of the lift and sold the shares of the company for his clients. Now, whether is he violating or not violating, because he did not ask anything. But if you've heard an information, the CEO is talking and the CEO is telling you something about, that company is going to go down or whatever, obviously that is a private information and you came across it. So you can't act on it. And also, you just came out of the lift, you just heard somebody talking in the lift and you'll sell your client's shares. What if that guy was talking about something else? Don't you think you should do your homework and then take trades on your client's behalf? So all these things happen. In fact, there was something with Axis Bank also where the fund managers did something. So this ethics becomes extremely important. So the questions will be like this. A situation is given and then we are going to be asking you whether he violated, not violated, etc. a standard. So that is your ethics, 7 standards. That is going to be the same, and 90% of ethics in all the 3 levels is the same. That is these 7 standards. So extremely well we have to do. We do like around 700, 800 plus examples in the class. It's very interesting. So we'll be, for every standard, I'll be giving you a situation and we'll be discussing whether this is a violation, not violation, etc. Very interesting subject, but confusing. I'm telling you, it is going to be a little confusing because it's ethics now. So you can't exactly say it's a 2 + 2 = 4 kind of a thing. Trust is a very easy chapter, 2-page kind of a chapter, that what is ethics, everybody should be ethical, profession, what is profession, etc. Very easy, nothing much. Gibbs, so just the way you have something called the ISO standards. When you're selling a product, you do those ISI mark, ISO mark, or ISO standards are there and ISI mark and all is there. It's basically like a thappa. You're stamping it that, this is all validated and this is correct and accurate information and all that. So now say, for example, a fund manager comes and tells you, I generated 20% return. Another fund manager comes and tells you, I generated 40% return. Now, if my last year was very good, I'll tell you my 1 year return. If my 1 year was very bad, my last 5 years was very good, I will not tell you 1 year return, I'll tell you my 5-year average return. So do you see how people can manipulate that, my return is this much, my return is this much, how they can manipulate and how they can try to market in a very bad way. So this Gibbs is basically global investment performance standards. So we are going to have certain rules which you follow when you're presenting your performance, that this is the return you generated, etc. You may or you may not follow the standards, that's up to you. If you follow the standard, then you can write, I have followed Gibbs. Otherwise, you can't write that. It's like that ISI mark. You're understanding? So that is there in your ethics. So standards and application examples and all that. We've discussed the 7 standards. That's same in level 1 and 2 and 3. So be very careful. The subject is extremely, extremely important. And Gibbs you have in more detail. Gibbs is a very small chapter in level 1. In level 2, it's not there. Level 3, you have a big Gibbs chapter. So this is your level 1 syllabus outline. Level 1, 2, 3, I told you, ethics is more or less. It's 90% of ethics is just standards only. Level 2, 3, I don't think we have much. Right? So this is your syllabus. So quants, economics, financial reporting analysis, equity, fixed income, alternate investments. You put those together into a portfolio, corporate finance, and ethics, right? Just a few more points. So how to study, there's another lecture. How do you go about with the studying? You do the lecture, you study, and then you practice. But details, how to study and how to practice, all that is covered. Interrelationships between the subjects you will have to understand. And any which ways, you will follow the order of study that I'll give you, in which order, which chapter you have to study in which order. So the interrelationship will not be a problem for you, because I'll sequence it in such a way. If I need chapter 20 to understand chapter 5, I'll put 20 before 5. I have to do 20 so that I can understand chapter 5. So that order will be given in that manner. So you don't have to worry. And practical skills module, obviously the financial modeling or Python or whatever you choose, the details are provided separately. That is not testable in your exam. So be it financial modeling or Python or whatever you're studying, in the practical skills module, that is not a part of your syllabus. That will not be tested in the exam. Just repeating this. And the demand supply, or those extra reading from economics, quants and accounts, financial reporting analysis, some extra reading, which is a prerequisite. You need to understand the concepts to understand this syllabus, but questions in the exam will not come on that, right? So this is your level 1 curriculum, and it's a really interesting one. So understand, figure out what your profile is, what you want to do, and this is basically broadly what is finance all about. So these are all the subjects in finance we have discussed. This is your curriculum for your CFA level 1.